Hello and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today. In our first segment, we talked a little bit about who is the top 1% earners in America. And what we found was that it's not necessarily concentrated in Wall Street, that it's actually fairly well distributed throughout society, although your executive managers and supervisors in non-financial occupations capture about a third of the top 1%. One other thing I thought I'd mention before we leave that topic of some of the fact-checking and who earns the top 1% in America is one of the other things that I hear these people that are protesting talk about, well, the banks, we need to protest the banks. They took all this bailout money and they need to pay that back. And you just look at that and you say, are they really that ignorant that they, flew or drove from San Francisco? That's another thing is, why is someone in Wall Street protesting and then they say, oh, well, what's your name? Where are you from? They say they're from San Francisco. Well, how do they get there? Where do they get the money to fly or drive out there to protest in Wall Street? It just makes no sense. Anyway, what these people don't realize, and I was against a lot of the bank bailouts. I think the TARP was a lot of wasted money. A lot of it went to the stimulus, and TARP and those things went to politicians, friend of politicians. So I'm against it as anybody else. But once again, if you're going to be protesting something, at least get your facts straight. And the banks have paid back the money that was loaned to them, especially the larger banks. There may be a community bank out there too, I don't know. But the large banks all paid the money back with interest, and the federal government made a rate of return on the money. So once again, not really for bailing out the banks, but the reality is they did pay it back, and they did pay it back with a net profit to the federal government. So if you're protesting the banks because they haven't paid back the stimulus money, you need to get your facts straight. Anyway, let's move on from there. As an investment advisor, financial advisor to many people, I'm constantly barraged with what people say rules of thumb. And just like in any profession, I suppose, I sort of cringe when I hear these rules of thumb, especially in today's day and age when computing power is very powerful and cheap, and you don't have to rely on these outdated rules of thumb at all. So I thought I would go through a few of them. The first one came about in the 70s and 80s. It was to determine the percentage of stocks you should have, subtract your age from 100. Now, I don't know why anyone would think this makes sense. Number one, people have different life expectancies. People have different income needs. People have all sorts of different scenarios. And to just say, well, I'm 50, so I should have 50% of my money in stocks is just completely ludicrous. We have clients that are late in their 90s that are never going to spend all the money they need. The money is for a foundation or for their children or something like that. And we have their money invested, to grow into the future. So your age has nothing to do with your allocation. Likewise, we have some very young people that are extremely risk averse. Let's say they're 25. Well, they have no business having 75% of their money in the stock market. They couldn't deal with the risk. So forget that. Subtract your age from 100. Makes no sense. Don't listen to it. Number two, keep 3 to 6 months of salary in an emergency fund. Once again, this really makes no sense to me. Number one, it should be based on your living expenses. Your emergency fund should be based on your living expenses, not your salary. You should figure out, if I lose my job, how much money do I need to get by? And that's the number that you should look at. If you're employed by the government or a teacher or something like that, and the likelihood of losing your job is essentially zero, won't get into that, but you have virtually no chance of walking into the office tomorrow and getting fired. If you're committing a crime or something like that, maybe you get fired. In New York City, you just go into the sort of limbo for several years and you continue to get paid. So there's virtually no chance of you getting fired. You don't need 3 to 6 months worth of living expenses in a reserve. It makes no sense. If you're self-employed or your business is going down the tubes, sure, you want to make sure you have some cash reserves. There are other sources of income. If you have a home equity line of credit, can be another source to tide you over. Number two is what people often forget about is if you get laid off and your income is drastically down, then withdrawing from retirement plans is not as detrimental because you're in a low tax bracket. I'm not advocating any one of these particular things for everyone, like the keep 3 to 6 months in emergency fund. What I'm saying is look at your particular situation, look at where you do have money, look at your sources of income, and come to some sort of reasonable financial decision. These rules of thumb were also based previously when in cash, you could make 3-4% on your money. Today you make virtually nothing, and so having large cash balances is just not a great strategy. Once again, another rule of thumb that we recommend people actually take a look at and come to a rational decision. Number 3, set aside 10% of your gross income for savings. To me, that's a starting point, 10% of your income. And actually, as I look at the clock here, that's going to be an ending point for this segment. When we come back after the break, we'll pick up and we'll talk about some more rules of thumb that I think make no sense, starting with saving 10% of your income. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.